Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Hello, and thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. For the most part, I enjoy spending time learning about investing. I know that there are a lot of people who find it boring. That may not be you since you're listening to a podcast on money and investing. But if you do have a friend who really finds this stuff boring, maybe have them listen to this episode. This episode is really for all of you out there who just want the answer. What investments do I choose for my retirement accounts? Or even for my long-term investing plans in my taxable brokerage accounts? The disclaimer is that I am not a certified financial planner, so do not consider this professional financial advice. And of course, you're listening to a podcast, so this is certainly not personalized financial advice. Take it as good, sound financial education and entertainment. I've talked a lot on this podcast about how important it is to both save and invest, and that saving itself is not enough to fund your retirement. I've coached physicians who've had their retirement accounts sitting in money market accounts because they were afraid to lose money. What I want to really impart on you is that you are pretty much guaranteed to lose the value of your money by keeping your retirement account money in a money market due to inflation. Inflation erodes the value of money over time. That money just won't grow. It may seem like there's more money because of the interest of the money market account, but that interest and that growth really is unlikely to even match inflation over time. If your money doesn't make money for you, you will continue to have to work for money. And at some point, you're going to want to cut back, cut down, or stop working. The simplest way to invest is investing in stocks and bonds through low-cost index funds. Low-cost index funds allow you to be invested in a large number of diversified stocks and bonds with a single purchase. I talk about index fund investing in episode 16 of the Grow Your Wealthy Mindset podcast, and we'll likely have future episodes on it as well. It is the topic of my talk for WCICon 2025. There's still time to sign up for the conference, and I would love to meet you in person if you're there. You can get a diversified investment in stocks and bonds at appropriate asset allocation ratios with a single target date fund. To learn more about target date funds, you can listen to episode 36 of the Grow Your Wealthy Mindset podcast. Target date retirement funds will have a year included in their name, and fund families will have target dates set for every 5 years. For example, Vanguard has target date funds for 2020, 2025, 2030, 2035, and so on through 2070. The Target Retirement Income Fund is for those who are already in retirement. There is likely some target date fund available in your retirement account through your employer. If you want one-stop investing, this is it. For investment goals that you have that aren't related to retirement, you can choose whatever year that goal would come to fruition. For example, if that goal is investing in your child's college fund and they're going to start college in 2035, then you could use a 2035 target fund if you wanted to for their 529 plan. The idea for using a target date fund for your retirement accounts is that as you get closer to retirement, the fund increases its bond holdings and decreases its stock holdings to make the portfolio more conservative as the goal gets closer. That's because stocks tend to have more volatility than bonds. Bonds are usually considered more conservative. Picking a target date fund means not having to rethink your investment allocation over time. So you don't have to constantly rebalance your portfolio and think, I'm getting closer to my goal. I'm going to get a little bit more conservative. I'm going to focus a lot of this episode based on investing for retirement, but of course, we invest for many other goals outside of retirement. If you want to retire 20 years from now, you could consider the target date fund for 2045. If we take a closer look at the Vanguard target date fund 2045, we find that it has an expense ratio of 0.08%, which is great, and a minimum investment of $1,000. The Vanguard Target Date Fund 2045 has 50.9% of its investment in the Vanguard Total Stock Market Index Fund, 33.2% of its investments in the Vanguard Total International Stock Index Fund, 11% of its investment in the Vanguard Total Bond Market 2 Index Fund, and 4.9% of its investment in the Vanguard Total International Bond 2 Index Fund. Overall, its investment ratio is 84.1% in stocks and 15.9% in bonds. As a comparison, let's look at the Vanguard Target Fund for 2025. The expense ratio is also 0.08% and the minimum investment is $1,000. This is true for really all of Vanguard Target Date funds. Here, there's a much lower investment in stocks and higher investment in bonds. 31.2% of the fund is invested in the Vanguard Total Stock Market Index Fund, and 21.1% is invested in the Vanguard Total International Stock Index Fund, for a total of 52.3% of the fund being invested in stocks. 28.8% of the fund is invested in the Vanguard Total Bond Market 2 Index Fund, and 12.4% in the Vanguard Total International Bond Index Fund, as well as 6.5% invested in the Vanguard Short-Term Inflation Protected Securities Index Fund. That totals 47.7% in bonds. This really shows that how an individual who's planning to retire soon would have a lot more bonds in their portfolio with less stocks than an individual who's planning to retire in 20 years. Again, the idea is that as you near retirement, these target date funds are going to adjust asset allocation to be more conservative, which really means increasing the percentage invested in bonds and decreasing the percentage invested in stocks. The reality is, if you're going to really use a single fund, you should at least think about for yourself and decide what percentage of your portfolio you want invested in stocks versus bonds and invest in that. So that might mean that you want to be a little bit more aggressive. And even though you may plan on retiring in 2045, that you invest in the fund for 2050 or 2055 in order to stay a little bit more aggressive. Vanguard also offers life strategy funds, which invest in the same funds as the target date funds, but do not change the asset allocation with time to favor more bonds as the years go by. There is the Life Strategy Income Fund, the Life Strategy Conservative Growth Fund, the Life Strategy Moderate Growth Fund, and the Life Strategy Growth Fund. Mike Pepper, who is a CPA and the author of several personal finance books, has his entire retirement portfolio invested in the Vanguard Life Strategy Growth Fund for over 10 years, starting from December 2011. He's written about this on his blog and talked about it on podcasts where he's been a guest. This fund is invested in 80% stocks and 20% bonds across the United States and international markets. The fund is invested 48% in Vanguard's Total Stock Market Index Fund, 32% in Vanguard's Total International Stock Market Index Fund, 32% in Vanguard's Total International Stock Index Fund, 14% in Vanguard's Total Bond Market 2 Index Fund, and 6% in Vanguard's Total International Bond Market 1 and 2 index funds. With the expense ratio of 0.14%, the Life Strategy Growth Fund does have a higher cost than using the individual index funds as well as the target date funds, but it's still a reasonable expense ratio and not bad for the convenience of having a hands-off investment where you don't have to rebalance. This fund is also not the most tax efficient, so it is better off in a retirement account. The other life strategy funds have a different ratio of stocks to bonds, but is otherwise similarly invested. The Life Strategy Moderate Growth Fund is a mix of 60% stocks and 40% bonds. The Life Strategy Conservative Growth Fund is 40% stocks and 20% bonds. And the Life Strategy Income Fund is 20% stocks and 80% bonds. So basically, it's giving the range of stocks and bonds, and you can choose within those ranges what kind of asset allocation you would like and invest in a single fund. You've probably noticed the trend that all these funds that I've mentioned basically have the same investments. The total stock market index fund, the total international stock market index fund, the total bond market index fund, and the total international bond index fund. These are 4-fund portfolios as opposed to what I talked about, a 3-fund portfolio, but you can build your own 3 or 4-fund portfolio using these index funds, which allows you to decide how much asset allocation you want in each type of investment. It does mean having more funds than one fund, but it also means a lower expense ratio, though just by a little bit. And it means total control over the percentage of the asset allocation. However, you'll have to rebalance to put yourself back to the asset allocation over time, so it comes with a little bit more work. And you actually have to make the decision of what you want your asset allocation to be, which for some people is a plus, and for some people, they'd rather just choose between choices given to them. For those of you listening to this podcast who live in the United States, it makes sense for us to invest in the US market for stocks and bonds. A caveat I should mention is that a lot of this investing education is really meant for people who do live and invest in the United States, since I am not knowledgeable about what's involved when someone from another country is investing in the United States and what their retirement accounts look like or any of what they go through. So back to investors in the United States. When it comes to international stocks, it does make sense to include them for added diversity. There are a lot of big, great companies that are obviously not US companies. I talk more about adding international stocks for diversification in episode 94 of the Grow Your Wealthy Mindset podcast. US and international stocks do have similar risk portfolios and similar long-term returns, so they're not so different from each other. So you can look at them as similar, but still have more diversification. Many US investors, including myself, will choose not to include the International Bond Index Fund due to added complexities and currency risks. Adding international bonds would increase diversification for the portfolio, which is generally considered a good thing. International bonds make up 52% of the global fixed income market, with US bonds representing 48% of that market. This is according to FactSet data as of March 31st, 2023. While Vanguard has fully embraced adding international bonds to their funds, other target date funds at other brokerages do not include international bonds. Neither Fidelity nor Charles Schwab target date funds include international bonds. For those of you who work at the VA, the Thrift Savings Plan does not have any international bond fund available to invest in. For the remaining of this episode, I'm really going to focus on the 3-fund portfolio, a portfolio consisting of the total stock market index fund, a total international stock market index fund, and a total US bond index fund. You could consider a bond fund that only invests in US government bonds instead of the total US bond market. If you did want to add an international bond index fund, you can make yourself a 4-fund portfolio, but if you're going to do that, Vanguard may be the best place to do it. After all, part of building a good portfolio is finding good index funds to put in it, and Vanguard does have a good international bond index fund. I sort of mentioned this earlier, but if you're going to build a 3-fund portfolio, you'll want to actually think about how much you want to place in each of the different funds, which is what your asset allocation will be for the different markets: domestic stocks, international stocks, and domestic bonds. At least 50% of your retirement portfolio should be invested in the stock market, whether that's domestic or international. This is supported by a number of research studies evaluating retirement portfolios and how long those portfolios will last before they become depleted. If you're sticking with only stocks and bonds in your investments, then no more than 50% of your portfolio should be invested in bonds for it to really have enough growth to sustain a long retirement. That being said, once you're retired, depending on your life expectancy and what age you're at, you may start increasing your bonds to more than 50% of your portfolio at that time. Here, we're really focusing on your portfolio until you get to retirement. There's a rule of thumb out there that says that the percentage of your retirement portfolio that should be in stocks is 100 minus your age. This means that if you're 40 years old, that would mean having 60% stocks, and 40% bonds. While that's not a terrible ratio, I personally think that that's not aggressive enough given our long life expectancies and people's desire to retire earlier if possible. Looking at target date funds, the percentage allocated to stocks is much higher than 60% for those that are dated 2035 or later when I look at Vanguard, Fidelity, Charles Schwab, and TSB target dated funds. Remember, a target date 2035 fund is for someone who's looking to retire in 10 years. That means if you're 40 and you plan to retire at age 50, you'd still want more than 60% stocks for your retirement portfolio, as suggested by the asset allocation in a target fund dated for 2035. If you're 40 and are looking to be more likely to retire at age 60, then you would look at target date funds for 2045, which also suggests having 80% or higher invested in stocks. One way to help you decide your asset allocation is by looking at target date funds for the year you want to retire to help determine that asset allocation. You could do this for the different target date funds at different brokerages and use any of their allocations or average all their allocations. But this will give you the confidence that you're in an appropriate range for your asset allocation, given the goal of when you want to retire. Once you've decided on your asset allocation, the next step is to choose which 3 funds to actually invest in. If it's a taxable brokerage account, obviously you can choose wherever you hold that, and good choices would be Vanguard, Fidelity, or Charles Schwab. If it's your employer-sponsored retirement plan, it's going to depend on what funds are available in that account. As I said, Vanguard, Fidelity, and Charles Schwab all have good low-cost index funds, and I'll have the names and ticker symbols of those index funds in the show notes. With the Thrift Savings Plan, you'll end up with 4 funds: the C and S funds for U.S. stocks, the I fund for international stocks, and the G fund for bonds. If your employer-sponsored retirement plan doesn't allow you access to Vanguard, Fidelity, or Charles Schwab funds, there are other funds by T. Rowe Price, Dreyfus, and Northern that have index funds that you can use to build your portfolio. If none of those funds are available, then you're really just going to have to look at what funds are available and make an educated choice on what would best fit the definition of a low-cost index fund that's invested in the market you're looking for, whether that's the total U.S. stock market, the total international stock market, or the total U.S. bond market or U.S. government bonds. Sometimes there may not actually be a U.S. stock market index fund. You may end up including an S&P 500 index fund and then another fund or two that includes mid-cap and small-cap stocks. If you're unable to find index funds with low expense ratios, ideally you want something less than 0.2%, then unfortunately you are going to have to do a little bit more work. Maybe you can find some index funds with expense ratios around 0.3% or 0.4%, but it gets higher and higher. You'll need to dig a little bit more and more. Episode 17, Choosing Investments in Your Employer-Sponsored Retirement Plan, may be a helpful episode to listen to if that's your situation. I know in this podcast episode, I've referred to a lot of prior episodes of this podcast. As I've done more and more teaching, I realize that saying the same information, but saying it in a different way or using different points and examples hits differently with different people. While some episodes of this podcast will overlap in information, repetition is a good thing. It helps us learn. My goal is to present the information from different angles so that as many people can learn and understand these concepts as possible. If there's a topic you would like to hear more about, let me know by emailing me at growyourwealthymindset@gmail.com. If you would like personal help in choosing your investments, I'm not a certified financial planner, but I can help you gain the education and confidence you need to make good decisions for yourself. If you're interested in working with me, set up a Zoom call at www.growyourwealthymindset.com so we can talk more. Thanks again so much for being a listener of the Grow Your Wealthy Mindset podcast. If anyone you know would benefit from listening to this episode, please share this podcast with them. You could take a screenshot and post it on your social media. If you're loving this podcast, write a 5-star review on Apple Podcast or your favorite podcast app. I'd love to try to reach as many people as possible so that we physicians can really all have financial literacy and build our wealth. I'll be back next week with another episode of the Grow Your Wealthy Mindset podcast. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.